Welcome everyone to Advanced Webinars. This would be part one of our QuickBooks Desktop for Manufacturing and Wholesaler series. In today's episode, we're going to talk about QuickBooks Desktop inventory workflows, average versus FIFO. Now, this would be part one of an 8-part series that starts today. The 8-part series will be recorded once per month for the next 8 months. So it will be May through December of 2020. Each month is going to deep dive into a specific topic. We're going to be talking about importing inventory items and making inventory adjustments and inventory adjustments in batch on the next episode. Then on the third episode, we're going to be talking about multiple locations, bin numbers, serial numbers, and lot numbers, and all the gotchas around working with multiple locations, bin numbers, serial numbers, and lot numbers. Then we're going to move into on episode 4. We're going to be talking about barcodes. So using the USB barcode scanner and also using the mobile warehouse Android app scanner, which are two different functions, very different altogether. So we're going to learn how they work with each other and what works with one and what doesn't work with the other. Then on episode 5, that's we're going to start diving deep into manufacturing specifically. So the first 4 sessions are mostly around inventory, getting your inventory right. And then we're going to move to manufacturing afterwards. So we're going to talk about multiple units of measure. We're going to talk about inventory assemblies, and we'll be talking about bill of material. So there'll be a really heavy focus around those topics coming episode 5, but you have to have all the inventory fundamentals first. And episode 6, we'll be talking about other advanced manufacturing workflows. We'll be talking about accounting for scrap, accounting for labor, accounting for third-party manufacturing process, and how all that stuff can affect your workflow. On episode, that will be episode 6. So episode 7 will be inventory management topics. We'll be talking about mostly around everything having to do with keeping inventory accurate and in real time and all the issues around not doing that. And then episode 8 will be sort of a capstone topic where we talk about all the leftover advanced inventory topics, shortcuts, workarounds, and efficiency tips and tricks. Somewhere in the middle of this, we'll be talking about new features coming out in QuickBooks Desktop 2021, which usually come out between September and October of 2020. So we'll intertwine those and bring those into the curriculum as well, because this series should be relevant for anyone using QuickBooks for manufacturing and wholesalers during 2020 and hopefully through 2021. I would love this to be very relevant for at least a year and a half. Again, today, everybody can access this episode for free. We have over 200 people logged in right now to watch episode 1. This is going to be recorded, and this one's going to go on YouTube. Episodes 2 to 8 will not be available for free. Episodes 2 to 8 will only be available for people that pay. So it's going to be a much smaller group, the ones that actually attend episodes 2 to 8, and you will have to pay for this. We will not be issuing CPEs, right? Just because I don't want to have a specific timeline, and I don't want to interrupt the webinar series with polling questions. So I made the decision not to make this CPE eligible. All right, let's talk table of contents. So we already spent 5 minutes talking about the webinar series and the introductions. Then we're going to move to comparing QuickBooks features across Pro, Premier, Enterprise Silver, and Enterprise Platinum. I think it's important to add some context and understand, depending on what version of QuickBooks Desktop you're using, how inventory features are specifically affected. Then we're going to be talking about non-inventory workflow and inventory workflow, just because a lot of inventory companies, a lot of wholesalers make the decision to make certain products non-inventory to kind of speed up the process. And we'll talk about how that affects cost of goods sold and all that stuff. Then we'll do a quick introduction to bill of materials and item assemblies. Again, we're going to spend a lot more time with this on part 4 or part 5. I forget which it was. We're going to deep dive into the manufacturing, but we'll do a quick introduction today. Then we'll talk about inventory valuation issues. What happens when your inventory is off? What that can do to your accounting negatively or positively. And then we can talk about some non-accounting challenges that can have as well. Then we'll talk about comparing average cost. We're going to go inside QuickBooks, compare average cost versus FIFO. And then you're going to see there's a lot of little very specific things to QuickBooks Desktop when it comes to average costing and exactly how it works. It's actually, in my opinion, I don't think is as straightforward or 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 the same as the way we're taught in school, the way average cost works. So we're going to do a couple of examples to kind of show you how that gets affected. Then we're going to be talking about landed costs. So this is adding the additional costs like shipping, insurance, customs, that sort of thing. Add that to the value of inventory. We're going to talk about a classic workaround that we've used for years for Pro and Premier. And then we're going to be talking about the new feature of landed costs inside QuickBooks Enterprise 2020 that does really speed up this process. That will be about 10 minutes for each one. Then we'll talk about find and select items and what I like to call the ultimate item fetching shortcut. You'll see we'll spend about 5 minutes on that. And then we're going to be talking about item receipt versus bill. Just conceptually, we want to know exactly what the differences between those are. And then we'll do a short introduction to enhanced inventory receiving, which in my opinion, it's a horrible feature that no one should ever use. If you can avoid using it 100%, I would, but we'll do a quick introduction to it regardless, so you're aware, because if you're supporting people with QuickBooks desktop files, they might already have this feature turned on, and it might be outside your control whether or not you can turn it on or off. Then we'll do a couple of minutes, maybe 10 minutes on open Q&A, and we'll do the outro, and then we'll talk about repeat just how to sign up for this series. I'm also going to email you the slides on top of the fact that I made the slides available in the chat section. So if you want to download the slides, just look for the link in the chat section and you can download that. Yeah, so if you signed up for the free webinar series portion, you will get an email with the slides on top of it. You can download it right now. Okay, so let's jump right to it. Comparing QuickBooks Pro, Premier, and Enterprise, specifically when it comes to inventory features. So I'm not going to compare anything else that's not inventory. Let's start with all versions of QuickBooks have the following. All versions of QuickBooks have non-posting transactions, such as estimates, which is the preamble to an invoice, and all QuickBooks Desktop versions have a purchase order, which is a preamble to an item receipt or a bill. Then we have the classic inventory affecting transactions. Anytime you use an inventory item in an invoice or in a sales receipt, that's going to reduce your inventory. Keep in mind that if you have an inventory item in an invoice or a sales receipt as a negative quantity, that would actually increase your inventory. You have the customer credit memo, which is when the customer returns product to you. But if you use an inventory item in a credit memo, that's going to increase your inventory. Then we have our item receipts, bills, checks, and credit card charges. All of these transactions, which are generally expense transactions, if they have an inventory item in it, they're going to be increasing your inventory. And then we have our vendor credit, which is when you return to a vendor a purchase of inventory, or a credit card credit, which is when you are getting refunded to your credit card for an inventory purchase you made through your credit card. If you have an inventory item in that credit card credit or an inventory item in the vendor credit, that's going to reduce your inventory because you're giving it back, quote unquote. And then we have the inventory adjustment that can increase or decrease the inventory depending on what you're doing in that adjustment. Now, journal entries are non-inventory affecting transactions, but many people mistakenly use journal entries to adjust the asset value of your inventory asset and offsets the numbers, and it creates huge problems. This is probably the number one issue we have as QuickBooks consultants working with manufacturers and wholesalers, is that their CPA or a person that doesn't know or understand QuickBooks will just plug in a journal entry into inventory to make it work, quote unquote, for the tax returns or whatever, but then causing a much deeper problem in the long run. Now, what is QuickBooks Pro missing? And this is the reason why I never would recommend QuickBooks Pro for a manufacturer or a wholesaler. So QuickBooks Pro is missing sales orders, probably the most important feature in the entire inventory workflow that it's missing. QuickBooks Pro is missing current availability, so the ability to tell you how much you have available, which is a mathematical calculation between quantity on hand minus what's already reserved or back ordered in a sales order. QuickBooks Pro doesn't have the sales order fulfillment worksheet, which allows you to print big tickets in batch. Okay, naturally, because there is no sales order in QuickBooks Pro, there's not going to be a sales order to a purchase order workflow. So that's going to be missing completely, which you get that in the Premier and Enterprise. So if you go to sales order to purchase order or estimate to purchase order, you want any of those features, you need to be working with Premier or Enterprise at the very least. Now, one really cool feature that Premier Enterprise have, it's automatically enter the customer's address in the drop ship location of the purchase order. So if you were to create an estimate or a sales order for a customer, and you were going to use that estimate or sales order to create a purchase order in which it's meant for the vendor to directly ship that to the customer, then it will automatically enter the customer's information in the ship to address. Really, really neat feature with Premier and Enterprise. Now, you don't get max reorder points or reordering reports with Pro. So you only get minimum reorder point. You don't get the max reorder point. And we're going to be talking about that on the next session, part 2, where we talk about entering the inventory and all the properties that has to do with the inventory. We'll be talking about max reorder points and what that means. Price levels. QuickBooks Pro can do percentage price level from original sales price, but it cannot set a price level based on cost, and it cannot set a price level that has a unique price level across the entire item. You will need Pro or Premier to do something like that. There's a feature in Pro and Premier which is item price in batch, which allows you to grab all your items, press a button, and automatically increase all your prices by a specific percentage across the board. That's not available in Pro. The Inventory Center is not available in Pro. Inventory Center in Enterprise allows you to add pictures to the inventory items. It cannot be used in forms, but at least you can use the pictures to identify what the item is. And of course, inventory assemblies, which would include a bill of materials and multiple units of measure, which are very, very important features for manufacturers specifically, is not in QuickBooks Pro. So hopefully from now on, if you were ever doubting whether QuickBooks Pro should be recommended for anyone that it's going to be using manufacturing and wholesale, this should basically quench the concept that you could use QuickBooks Pro. No QuickBooks Pro for manufacturing and wholesale, period, ever. You need to work at least with Premier and at least with Enterprise. So let's talk about now what Premier is missing that Enterprise does have. So Enterprise can do, technically doesn't have a maximum, based on their marketing material. QuickBooks Enterprise doesn't have a maximum number of items. That means you can have, quote, unlimited number of items. QuickBooks Pro and Premier has a hard limit to 14,500. Many people upgrade to Enterprise from Pro or Premier because they reach that limit. One thing I tell you, I warn you, that many QuickBooks Enterprise files that have 50,000 items or more, they're inoperable. So even though it says there's no limit, there is a database limit in which the software is useful. So I think that 50,000 to 100,000, it's kind of that real upper limit. But honestly, you're gonna have to be cleaning up the file or move beyond QuickBooks if you want the file to perform well. Now, custom fields. So QuickBooks Pro and Premier has 5 custom fields, but QuickBooks Enterprise can do 10 custom fields. And on top of that, the custom fields have the ability to do drop down. So it's a big feature in Enterprise. Now, one thing I love that they added a couple years ago is default class by item. You can actually set an item to have a default class. So every time the item is used, that specific class is automatically selected, which will really speed up your data entry process, and it will improve your reports if you want to have sales, let's say a report profit and loss by class, and the classes are driven by the items. So a lot of people will use classes to group items in like their respective categories. So they categorize or group the items with a class, and then this default feature really helps to speed up that process. In Enterprise, you can do auto PO. That means you can convert, and we're going to be covering this on on a future session where you can automatically create purchase orders based on reorder points. QuickBooks Enterprise has shortage reports, which is when you try to build a inventory assembly and you're short on a specific item or group of items. It gives you a report so you know what you need to order or reorder in order to be able to go back and build that assembly. There's a function called where used. That's a D. Where used, ability to replace components across all assemblies used. So what that means is, let's say you have a specific component that's used across, let's say 50 assemblies, and that component is now being replaced because it's been deemed obsolete, or there's a cheaper replacement for that component. You can, in one click, pick all the assemblies that are using the old component, replace it with a new component, and then update all your assemblies. We will cover that when we talk about inventory assemblies. The ability to edit assemblies on the fly during an inventory assembly or a pending build. To me, this is probably one of the most important featurettes. Not really a major feature, but it's so important when you're doing assemblies. Many times in the middle of an assembly, you want to make a change to that assembly, and you don't want to go back into the item and edit the bill of materials. You can actually edit the bill of materials on the fly while you're building the assembly or with a pending build. In QuickBooks Enterprise, you cannot do that with Premier. It's kind of a big deal. You can also automatically build some assemblies. So if you have an assembly that's a component of another assembly, you can press one button, and while you build the higher level assembly, it can go in and build its sub-assemblies. We're going to cover that on the assemblies portion of this webinar series, which will be about 3 episodes from now. Then you can also automatically adjust sales prices based on cost. So if your costs change, okay, so if costs change, you can tell it, look, I should always be making 35% on this item. So QuickBooks will actually give you a pop-up saying, hey, this cost change, would you like to change the sales price of this item to adhere to the 35% gross margin? This is whether the change goes up or it goes down. So that really can automate your price setting process. With QuickBooks Enterprise, you can disallow negative inventory items and disallow sales to overdue customers, which will really put a lot of controls in the process. Basically, with disallowing negative inventory items, if that feature is turned on, then you cannot create an invoice that will drive the inventory to go negative. Okay, and if your customers have at least one overdue invoice, so one invoice that's past due, you can stop QuickBooks, or you can just have a rule where QuickBooks will not allow that person to make an additional sale to the overdue customer. Those two features are in Enterprise only. Now, another really cool small featurette, but it becomes really useful, is to be able to see the item cost inside of a sales transaction. So when you're creating an invoice, you pull up an item, it will show you the cost in the sales transaction, so you don't have to go into the item list to review the cost. You can sort columns in transactions and search items within transactions, which is particularly valuable for very long sales orders or very long purchase orders where you kind of lost your train of thought and you're like, where was I? Where is this item? You can search within it, or you can sort alphabetically, numerically. In the sales transactions, you don't have that in Pro Premier, only in Enterprise. And there's a really awesome feature called Find Select. We're going to cover this today, actually, within the forms that only Enterprise has. And of course, if you're using the Platinum version of QuickBooks Enterprise, you get advanced pricing and advanced inventory features. Now, with QuickBooks Enterprise Platinum, the advanced pricing features is basically two things. One is price rules. Price rules allows you to have multiple conditions. So depending on who the customer is, what the class that is selected, the item that you pick, and the rep, and you can pick any of those in combination, you can tell it, set the price for these items at this specific price point or at this specific discount. So you can create really smart rules when it comes to simplifying the process for salespeople to be applying a specific price or discount into an item. It can also support volume discounting. So you can tell it based on how many units people buy, you can automatically discount the item by a specific percentage. So that's advanced pricing. Now, advanced inventory is a set of features that has been in development in the last 5 to 6 years. USB barcode scanner support, probably one of the most dominant one, or at least the ones that end users clamor the most. So you can actually plug in a USB barcode scanner, and you can scan the barcodes in the so it enters the items in the transactions. So this works with a bill for receiving inventory, and it works with an invoice for selling inventory. It also works for actually setting up the item. So if you want to scan the barcode so you can set up the item in your item list, that's what the USB barcode scanner is for. It can also support multiple inventory sites and bins. So you have to have multiple inventory sites turned on to have bins turned on. So a bin is basically a sub-inventory site in a nutshell. So you can have multiple physical warehouses where inventory is, and then also you can have multiple spots within that warehouse, which that would be the bin. Now with that QuickBooks Enterprise Platinum, you also have the option to turn on FIFO. We're going to cover this in detail today. It is so important to understand that specific point. We're going to cover that in detail. You can also do serial numbers and lot numbers. Serial numbers or lot numbers. You get the choice of one or the other. So you can, Enterprise Platinum supports that. There's also the fairly new mobile Android app, or the warehouse management app, which allows you to use a mobile device, which is an Android-based phone with a built-in barcode, to do certain functions. We're going to cover this in detail in one of the upcoming sessions. You can do alternative vendor support, so you can have a preferred vendor, and then you can have 4 alternative vendors, and it has a table inside QuickBooks that stores information like cost per vendor across these 5 vendors, or lead time across these 5 vendors. So many times you have one product that you buy with multiple vendors, and you want to make a decision of where should I buy that product, or who should I buy that product from. And then landed cost, which we're going to cover in today's episode. So a lot of stuff to know. And again, I made the slides available because I know there's a lot of these things you're going to need to print and review and have as a cheat sheet when you're making decisions. One thing I would also strongly recommend is take a look at my website on that specific link. Let me share this one so you can see it real quick. It's going to be in the slides, but I'm going to share it with you so you can see it. So in my website, I have a page called "What QuickBooks Enterprise Can or Cannot Do with Inventory," and I update this roughly once a month. And every time I realize of something really good that QuickBooks can do with inventory, I add it to the list. There's a whole bunch of things that QuickBooks can do, but then you will notice as you scroll down, the list of the things that QuickBooks cannot do with inventory, it's actually even longer. So what happens is when somebody emails me randomly, or a lead, or they say, "Hector, I need you to help me with my inventory," the first thing I do is, especially if I don't know the person, says, "Before we talk about QuickBooks inventory, I need you to read this article because I want you to know up front what QuickBooks cannot do, so there's no surprises 2 months into the implementation where you're making the assumption that QuickBooks would do that thing." So I try to add every single thing that comes out that hey, you cannot do this with QuickBooks, and there's absolutely no possibility to do this with QuickBooks. I put it in this website. So you got all the things that QuickBooks can do with inventory, and then you have all the things that QuickBooks cannot do with inventory later in there. I also get tons of feedback from my colleagues that come back and tell me, "Hey, you forgot to mention this specific thing," and I go back and I add it to the list. So that link is going to be on the slides. I'm also going to copy and paste that in the chat the description section below. So if you go into the chat, you can see the link, but it's inside the slides as well. So all the resources are going to be inside the slides. And also, you will notice that on the bottom of the page, I have what I call the questions to ask. So I have, since I do a lot of inventory consulting, as a matter of fact, I personally make a living doing inventory consulting. I have a list of about 20 questions that I go through and ask every new client about inventory, so I can get a good idea for what they expect how they expect their inventory to work. And then once you go through all these questions and your customer can answer them, or if you happen to be the end user that's going to make a decision whether or not to upgrade to QuickBooks or implement any sort of inventory system, if you go through these questions, you're going to have a really great framework for, hey, what is my expectation for what QuickBooks should be doing or not be doing when it comes to inventory. All right, so let me go back into the slides here. Okay, so those two slides cover that, and that's all going to be within the same page. So let's talk about our basic inventory workflows. So I'm going to switch over to QuickBooks now. So we're finally 30 minutes in. I'm going to switch over to QuickBooks, and then I'm going to go through these 5 things: non-inventory parts, single-sided and double-sided, purchase workflow, sales workflow, inventory consumption workflow. That's the one that a lot of people don't know. And basic inventory quantity adjustment, just so we understand exactly how QuickBooks sees inventory, how it affects it or doesn't. Okay, so let me switch to QuickBooks here. So I'm going to launch my my QuickBooks. Meanwhile, let me see if there's any questions I can be answering from the Q&A. So one person's asking, how would Bill.com work with QuickBooks Desktop on purchase orders? So generally, Bill.com is not going to be a good option for building purchase orders and bills, because generally people will create the bill in Bill.com and expect that bill to flow through with QuickBooks. So when it comes to inventory in particular, you need to be creating the purchase order in QuickBooks. You need to be creating the bill in QuickBooks, and then you need QuickBooks to be pushing the bill up to Bill.com. You're not going to be able to automate inputting the bill in Bill.com. You have to create the bill inside QuickBooks. So that's that question there. Juby says, I have a furniture selling client who's maxed out of the number of items and names in QuickBooks Premier. I was wondering if you recommend to go to QuickBooks Enterprise or move out of QuickBooks totally. So I would say, because there is a 60-day free trial on QuickBooks Enterprise purchases, I would move to QuickBooks Enterprise, do the upgrade, use it for maybe a week or two, see how you feel before going to a third party. I know I have many clients that move out of QuickBooks because QuickBooks reaches its limit. The problem that I have for the most part is that most people regret moving out of QuickBooks because no software out there it's as easy to use, easy to understand, and as user-friendly when it comes to pulling data reports. Almost all these high-end inventory programs are a pain in the butt to pull up, especially inventory level reports. So that's why I say very rarely I personally would recommend someone that loves QuickBooks to move out of QuickBooks if it's possible to stay within QuickBooks Enterprise. Okay, all right. So let's go ahead and talk to or talk about inventory basic workflow. So I'm going to go into my item list, and a quick shortcut. There is a shortcut for chart of accounts, which is Control A, but there's no shortcut for the item list that you hit with Control. But if you use Alt LI, so the Alt key, L and I, that is actually going to pull up your item list. So Alt LI, it's a quick shortcut to go to your item list. So I'm going to go ahead and create a new item. I'm going to hit Control N on the keyboard, which will create a new item. And then I'm going to create a non-inventory part. So I'm going to call this one NI for non-inventory, single-sided. Okay, and then under account, I'm going to choose generic sales account. Let me use sales of product here. And I'm going to go ahead and click OK. So I created a non-inventory single-sided side. I'm going to go ahead and duplicate this item by right-clicking on it and clicking on duplicate. So I'm going to duplicate that, and then I'm going to call this one NI double-sided. Okay, and double-sided item, basically a double-sided item, it's an item that you hit this little checkbox that says this item is used in assembly or for purchases specific to a customer or job. So as long as you click on this box, magically this item now is a double-sided item. And the difference between a single-sided item and a double-sided item is that a double-sided item will have two accounts that it will interact with. And as long as the transaction, it's a purchase transaction, such as a bill, credit card charge, or a check, it will use the account on the left-hand side. And if the non-inventory part is used in a sales transaction, like an invoice or a sales receipt, it will be using the account on the right-hand side. So double-sided means what account should I be hitting when I use a cost type of transaction versus a purchase, a sales type of transaction. That's all the difference between double-sided and single-sided items. But there's some specific drawbacks from using single-sided items, which I'll display in a second. So let me go ahead and hit OK. So I have two items, NI double-sided and NI single-sided. Let me go ahead and inactivate these other two. That way we're only looking at one thing. So I got two items, and then I'm going to create a purchase transaction for the double-sided item. So I'm going to go into vendors. I'm going to go to enter bills, and I'll create a purchase transaction. So let's put here sample vendor. And I'm going to go ahead and instead of using the expense tab, I'm going to use the item tab. And then I'm going to use the NI single-sided item. And I'm going to purchase, let's say 10 at $100 each. And then I'm going to go to my double-sided item. And then I'll purchase 5 at $1,000 each. Okay. So I'm just creating a regular bill, and I'm buying some double-sided items and some single-sided items. I'm going to go ahead and click on Save and Close. Now, what are the effects of purchasing single-sided items and double-sided items? I'm going to go into the profit and loss report and show you. And let's just do today's date. Okay. And this is the problem. Okay. A double-sided item will properly send our purchases to the cost of goods sold account that I used at $5,000. A single-sided item, because the account that I used in that single-sided item was an income account, it reported the purchase as a negative income. So if you are going to make the decision of using a single-sided item a non-inventory item instead of an inventory item, just make sure you make it double-sided so you can post the purchases correctly. Either way, the mathematical cost of these non-inventory items is a total of $6,000, but the problem is presentation. Like, do you want a purchase to come in as a negative income? Most people don't, right? So let me zoom this in a little bit so I can have the report a little bit bigger, and then I'm also gonna do one more transaction. So now let me do a sales transaction of these single-sided and double-sided non-inventory items. So I'm gonna go into customers and go into invoices, and I'll create a sample customer. Okay, and I'm gonna sell, let's say 50 double-sided items at $125 each, and then I'm going to sell 25 single-sided items at, let's say, $75 each. Okay, then I'm going to go ahead and click on Save. Okay, and then I'm going to click on Save and Close. So what ends up happening? So now we have kind of the income and the expenses that are posting based on these transactions. So if you go sales subproduct, the total is $71.25. If I double click on that, we can actually see the mathematical calculation of how this is happening. So I have two sales of the items. One is the double-sided item and one's the single-sided item. I'm going to go ahead and enable the items here so we can see them. So we'll be able to see which items we're using. So right here. Okay, so we can see when we sold the single-sided item, actually I'm going to click total by item detail. That's going to simplify here. So when we invoiced the double-sided item, it went into credit correctly, which is the sale should always be a credit. Testing. Quick audio check. Can you guys hear my audio? Just one person said they couldn't hear my audio. Yeah, okay. So that might just be one person. Okay. Sorry about that. Okay, so we have the double-sided item when it's sold, it reports to the credit correctly. The single-sided item when it's sold, it reports the invoice correctly to the credit, but it shows incorrectly the purchase or the bill as a negative income. So that's one of the big issues with single-sided items. So you can see it here very clearly. Okay. Now, one thing that's really neat about non-inventory items, you can still check profitability of the non-inventory items overall. So if I actually double click on cost of goods sold, gross profit, I'm going to double click on gross profit, and then I double click on that, and then I'm going to total by, in this case, by item detail. I actually can see on the item, per item, total debits, total credits, and how much profit. And this would be cash flow profit, to be clear, cash flow profit, not necessarily accounting or accrual profit, but cash flow profit on each one. So you see that I sold $6,250 worth of double-sided items, and I purchased 5,000, and then I sold $1,875 in single-sided items, and I purchased 1,000. Now, this doesn't tell me how much are available, how much are in stock. You would have to do manual calculations for this, because unfortunately these are non-inventory items. Now I'm going to go ahead and click on Customize Report and enable quantity, just to kind of also simplify this a little bit, and then click on OK. And this will tell you exactly how much were invoiced and how much were purchased. You could, in theory, do the math, right, and see how many you purchased versus how many you sold, right? How many you purchased before how many you sold, and you can try to figure out where the error potentially could be. But of course, non-inventory items are designed to not track quantities. Okay. Now you can also go to Report, Jobs, Time, and Mileage, and go to Item Profitability. Okay. And you can see your double-sided items and your single-sided items. Now notice that nothing is posting into actual costs, because these are non-inventory items. So unfortunately, you're not going to get item profitability in non-inventory parts. You're only going to get that in inventory parts. Okay, so that's a really, really important piece, that QuickBooks does not track cost in the item level on non-inventory parts. It can track it on the profit and loss report. You can see the debits and credits, but you will not see it on the item profitability report. Perfect. Okay, so the next topic here is, so now we understand inventory items and non-inventory items. Let's pull up the profit and loss again. Okay, and let's do this by day. So we're gonna do, let's do today and tomorrow. Okay, and I'm gonna break this down by day. That way we can see the activities for the non-inventory parts and the activities for the inventory parts. I'm gonna go ahead and make some inventory part purchases now. So let me go into my item list. And I'm gonna create a new inventory part. So I'm gonna go to New. Then I'm gonna select Inventory Part. So I'm gonna call it IP1. And then for the cost of goods sold account, I'm actually going to pick the same cost of goods sold account that I was using before, purchases of resale items. For the income account, I'm going to use the same sales account that we were using, sales of product. And then very important, we need to have an inventory asset account. Most people don't need to change the inventory asset account. They can just leave the default one. When we talk about inventory assemblies, we're going to be talking about having multiple inventory asset accounts for components, raw materials, work in process, finished goods, that sort of thing. But for now, for wholesalers, a single inventory asset account should be okay. Okay, so I'm going to go ahead and click OK. And there's my IP1, my inventory part number 1. So let me go ahead and now make a purchase of that inventory part. So I'm going to go into vendors, enter bills. I'll pick the same vendor here. Then I'm going to choose IP1. and I'm going to purchase, let's say 2,000 of these at $12 each. Okay, so I'm purchasing an inventory part. I'm purchasing inventory. And I'm also going to date this at 22nd because I just want to separate the P&L components to this. Click on save. Close that. Now, what happens to my profit and loss report? It's not showing any purchases right now because I use an inventory part. The difference between a non-inventory part and an inventory part is an inventory part has 3 accounts. The inventory asset account is the first account where that purchase goes into, and it doesn't get transferred into cost the way it did with non-inventory parts until the product is sold. In other words, only invoices and sales receipts can actually create a cost of goods sold entry into QuickBooks. So where is that purchase? That's going to be sitting in my balance sheet. So when I pull up my balance sheet, and I pull this up for the 22nd, you're going to see that I have an inventory asset account for $24,000. And that's going to sit there until I actually sell the product. So I'm going to go ahead and sell the product. I'm going to go ahead and go to customers, create invoice. And I'll pick the same customer on the 22nd. Let's go ahead and sell 10 of these units of the IP ones, and let's sell these at $21 each. Let me go ahead and click on save. And I'll go back to my profit and loss. And this is what we're expecting. We're expecting the $210 sale posted into sales of product. We're expecting the cost of goods sold, which is 10 units times $12 each, to post into purchases or costs or cost of goods sold. And then I'm also expecting to go into my balance sheet, and let me push this for the 22nd, and I'm expecting the 24,000 not to be 24,000 anymore. I'm expecting it to be 24,000 minus the 120 that posted into that cost of goods sold. If I actually double click on this inventory asset and I break these down, but actually let me do this balance sheet for 2 days, might be easier, and just do this by day like this. Okay, I'm gonna go ahead and move the original bill purchase to the previous day to make it easier to compare. So I'm actually pushing the purchase back 1 day so I can look at the balance sheet report and I can see how much inventory I had the day I bought it, and then how much inventory I have the day I sold it. So you can see that movement very clearly in there. And if you double click on that and look at the history, you can see the original purchase for $24,000, and then you can see the reduction of the inventory for $120, which basically moved it over to cost of goods sold. If I take the same report, I'm going to increase the font a little bit here, and I enable the account column. So let me collapse some of these. Okay, so notice the split column is open, but if I enable the account column, I can see which is the other account being affected, right? So we're seeing here that the original purchase affects my inventory asset by $24,000 against accounts payable, which is my bill. Then the sale reduces my asset by 120, sends it to accounts receivable. But then when I go into the invoice, I can actually now see the debits and credits inside the invoice by hitting Control Y on the keyboard. Control Y on the keyboard will give me what's called a transaction journal. And now in here, I'll be able to know exactly what's going on inside this transaction and know what are the debits and credits in this transaction. I'll make the font a little bit bigger here. And you can see here is the accounts receivable overall for 210, which is my sale. Then I'm seeing $120 being pulled out of inventory asset, and now that's being sent into the purchases or cost of goods sold account. So again, in conclusion, it is the invoice itself that creates the cost of goods sold. So that being said, people ask me, hey, should I ever have a non-inventory part? Should I ever even do non-inventory? Should I always do inventory? Look, it depends. In many situations, people need non-inventory parts to track sales in which they don't want to track the inventory asset, just because it's very difficult to do, because they're not going to upkeep with it, because the value is insignificant, or the end users are too likely to use the wrong item. So for that particular group, people are going to be using non-inventory parts. Now, if you are using non-inventory parts, should you ever use single-sided items? Well, it depends. Sometimes you use an item only for a sale, or sometimes you use an item only for a purchase. And at that point, you really don't need to have double-sided. But I would recommend that people just make all items double-sided, especially the non-inventory items, just in case. Okay, so that covers the workflow. So that covers the workflow, the initial workflow here. Let's pull up the PowerPoint real quick. Just make sure we're not missing anything. Okay, so the next step here is going to be inventory consumption workflow. So inventory consumption is different than an inventory sale. So in this specific use case, you're seeing sales. You're seeing us actually selling the inventory at a positive dollar value. But let me bring this up one more day. And then on the 23rd, what I'm going to do is I'm going to consume inventory that I'm not going to sell. So I am tracking the inventory. I have it in my inventory asset. I have it in my valuation of inventory, but I don't want to sell it, but I want to consume it for a project. I want to consume it for a job. So there's many situations in which that happens, where we keep and track inventory, but then we're going to consume the inventory for a job that's going to combine inventory and services. Or maybe we charged a lump sum, but we're going to be distributing the inventory items in different pieces, and then we want to reflect the consumption of those inventory items as the project goes on. So it's actually a very simple process. You knowing that the only transactions that affect inventory, that reduce inventory and cost of goods sold, is invoices and sales receipts, then all you need to know is that you need to create an inventory, a sales receipt at a 0 sales price. So for example, let's say I'm going to go ahead and for a job, I'm going to consume some of my IP1 inventory items. So all I have to do is create a sales receipt. Where's my sales receipt? Right here. So I'm going to go to enter a sales receipt. I'll select my customer or project that I want to consume the inventory for. I pick in my item list which inventory part I want to consume. I select the number of units that I want to consume. Let's say I want to consume 100 units for a project. And then all I have to do is sell it at a rate of 0. That's all you have to do. Set it at a rate of 0. In the memo, you can just call it consumption or something like that. The reason why you may want to have a memo there is because if you're consistent with what you put in there, you could run a report of all the sales receipts that are consuming items by having the memo there. So I'm going to go ahead and I'm going to leave it at 0, select the quantity, hit save. And for most people, especially brand new QuickBooks users that are looking at this, they're like, well, a sales receipt at 0 sales price will not affect my numbers at all. This is not true. A sales receipt with 0 sales price, true, it doesn't affect your sales. True, it doesn't affect your banking. But because you're using an inventory part, you are affecting cost of goods sold. I'm going to click Control Y on the keyboard and show you. So look, even though my sales account is not being affected, is 0, there is a debit and a credit to my inventory asset and my cost of goods sold and my purchases account. And that's happening behind the scenes because I'm using an inventory part. So every time you use an inventory part, whether you profit from it or not, whether you sell it at a dollar value or at 0, it will affect your cost of goods sold. Your cost of goods sold. So notice that on May 23rd, which is the day that I created a sales receipt, I now see $1,200 posted into my purchases or cost of goods sold account. So that's a little bit of a hidden workflow. Most people don't think about that too much, but that's important too, because a lot of companies, that's how they work. They'll consume the inventory, not necessarily sell it. So they want to track it for control, but they want to consume it to know what's going on with their jobs. Perfect. Okay, so let's move on now to inventory quantity adjustments. So naturally, any companies, wholesalers, or manufacturers that are running inventory, that are keeping track of inventory, they should be monitoring their inventory valuation summary report in a daily basis. Okay, so they're going to go to inventory valuation summary, and they should always be monitoring this in a daily basis. You want to make sure that your inventory counts are accurate. In many factors, you will, in many situations, you will research what's wrong with this item. So for example, let's say I'm looking at my inventory valuation report, and I'm going to go physically to my warehouse and make sure that I have 1,890 units in stock. So I go physically and I count, and my stock says that I have 1,900, not 1,890. Or let's say, 1,900, not 1,890. So I'm missing 10. So in some cases, people will go crazy looking for that 10. I will show you a quick troubleshooting tip for that. You go into the item list, and then you right click on the item that you're researching, and you click on quick report, and this should give you a history of every time this item is being used. So you can see when it was purchased, when it was sold, whether there's an invoice or a sales receipt, and maybe looking at the history will give you a clue of what happened to the inventory. Okay, in some cases, you will realize that maybe this invoice is bogus, this 10 invoice is bogus, and that's why that might be causing the issue. And if you can, during the troubleshooting, find out what the problem is, and the problem is you use the wrong item on an invoice or a bill, or you use the wrong quantity, just fix it historically on your transactions. But then if you get to the point that it's too much work, or you don't know where the error happened, all you have to do is make the inventory adjustment using the adjustment window. So we're going to go into inventory, and then we're going to click on adjust quantity and value on hand. You can also click on manufacturing and wholesale, inventory activities, adjust quantity value on hand. They both get you to the exact same screen. Okay. Then we pick the date that we want to adjust our inventory. Let's say I want to adjust it as of the 23rd. The adjustment account, this should always be your cost of goods sold account, the same generic cost of goods sold account you use for everything. So you should always be using that. One of the major errors that people have here, and it's probably the biggest capital sin of all, is they'll use the inventory asset account to adjust inventory, and then inventory is really never adjusted. Basically, it comes in and out into the same account. So if you're making an inventory adjustment, you must post the value of that adjustment into your profit and loss. You got to take the hit, some cases positive or negative, because making an adjustment means affecting your financial statements, and that's the way it's supposed to be. So we're going to pick the item that we're going to adjust. It says here that we have 1,890, but the real quantity is actually 1,900. So we type in the adjustment. So we're doing a positive adjustment of $10, which here in the bottom right, it says that I'm adding $120 to my net income. So I'm reducing $120 from my cost of goods sold by making this inventory adjustment. So if you're not sure about that, you would click on Control Y. So let me save it and come back to it. And then you can hit Control Y on the keyboard, and then you can see exactly what's going on here. And this will tell you what's happening, right? So this transaction is posting a credit or a reversal of an expense to my cost of goods sold account, and is increasing my inventory by $120. Okay. Now, many people suggest not to use the generic cost of goods sold account and create an account called inventory adjustments. That could be done. Inventory adjustments, depending on, in my opinion, depending on the user. Some users get freaked out when they see an inventory adjustment number in the P&L, and they prefer to just mask it or make it recalculate in cost of goods sold. Some people, especially the inventory has been right for a very long time, and all of a sudden it's becoming an issue, they want to see the adjustment so they can see the effect of every adjustment made. Either way, it needs to be a cost of goods sold account, period. It needs to be a cost of goods sold account, period. It doesn't matter which cost of goods sold account is. It's going to be a presentation issue. Do you want to hide it and include it with the rest of the cost of goods sold to avoid any confusion, or do you actually want to highlight the adjustments to inventory? So I'm going to click Save and Close and click and show you that. Let me get out of here and show you the profit and loss again. So let's go ahead and put a profit and loss. We'll make this for the next 3 days and group it by day. I find this to be the easiest way to kind of show the net results of all the transactions that we're creating. So you're going to see on May 23rd, you see a negative cost, an adjustment to cost, an increase in income, right? Because inventory that we thought we sold or lost now magically appeared. So that's what a positive inventory adjustment does, which is it brings up inventory, which is different than a negative adjustment or adjustment going down, which will bring down your inventory and then increase your costs. Perfect. All right. So let me switch over here to the PowerPoint. Okay, the PowerPoint includes some screenshots of the stuff that we talked about just now. So make sure you download those PowerPoints. I'm gonna be making PowerPoints for all 8 of the series. Of course, only the folks that are involved in the paid webinar, where they're gonna have access to all 8 of them, will have access to all the slides. But everyone watching this first part should have access to these slides. I recommend you at least use those. Okay, so let's move on to Introduction to Bill of Materials and Inventory Assemblies. We're going to do this rather quickly because this is only a 2-hour webinar, and we're going to be covering this. We're going to have an entire episode around inventory assemblies. Okay, so let's go into our item list. Remember the shortcut is Alt-LI. So we're going to go into the item list, and generally when we do inventory assemblies, we should always do the components first. So let's say we have a assembly product that's going to contain 2 raw components or raw materials in it. So I'm going to go ahead and create a new inventory part, and I'm going to call this one RM1. This is our first raw materials item. Now, when you're dealing with inventory assemblies, you must always enter a cost here. You're going to see how that works in major detail on the episode where we talk about inventory assemblies, but you should be able to see it here. So let's say this raw material costs $10 each. Okay, and the sales price really doesn't matter that much, but I do have to pick a sales or product. Now, generally speaking, what you're probably not going to be selling raw materials, so it doesn't matter which cost of goods sold account you use. Just try to be consistent with the rest of your file anyway. It doesn't really matter which one we use, because generally we're not going to sell raw materials. We're going to be selling the end product, the inventory assembly product. But I do recommend that we create an asset account just for raw materials. So what I'm going to do is I'm going to create a sub account under inventory asset called raw materials. So I'm going to create an other current asset account called raw materials, which is going to be a sub account of my inventory asset account. And then I'm going to click Save and Close. Okay, perfect. So there's my raw materials sub account under inventory assets. I'm going to go ahead and click OK. And then I'm going to create a second raw material. I'm going to right click and duplicate it. So I'm going to call this one RM2. And let's say this raw material costs, let's say $75 each. Same thing. I want to make sure that it's going to go into raw materials. Okay. So now I'm going to create a inventory assembly that is going to be the finished product of putting both of these raw material together. So I'm going to go ahead and create a new item, and I'm going to make this an inventory assembly, and I'm going to call this finished product unit. Okay, so a finished product unit, and then I'm going to go ahead and here where it says bill of materials, tell it how many of the raw materials it's inside one finished product unit. So let's say that we use 2 raw material 1 on this unit, and then we use, let's say, 10 raw material So this bill of materials contains basically a process in which we take a whole bunch of inventory parts, which we're calling raw materials, and create one finished good in here. So this finished product unit, let's call it unit 1, has a cost of $770. So you actually can see what the cost is based on the cost in each of the individual inventory items. So when you come up with a sales price, then at that point you want to maybe increase that to whatever the markup or margin that you want to use. Now here where it says cost, it's really important that you pick either user defined cost, which means I type in the cost myself. That means I can type in 770 or I can type in whatever I want, or I can change total BOM cost, lock that field in, and have that field automatically update when you change the bill of materials. Now, on the episode where we're going to be talking about how bill of material works in details, we're going to be talking about the difference between the average cost of those materials versus the cost that you're seeing here, because it does make a difference. The average cost of the materials is a different number, or essentially could be a different number than the index cost or the item cost that we enter in the item list. So this cost is actually kind of irrelevant when it comes to inventory asset, but it's very relevant when it comes to setting up a sales price. So let's say, for example, we sell this one for $990, and this would now tell me what my markup and my margin is. Nice thing about QuickBooks Enterprise is you get this markup and margin field here. QuickBooks Premier doesn't give you that. So QuickBooks Premier will not give you markup and margin. Only QuickBooks Enterprise will give you a markup and margin. And what's also nice about it is you can go here where it says edit markup, and you can say, look, I want to mark up all my products 30%. So you just type in the markup here and then click OK, and QuickBooks will automatically calculate the sales price for you based on the target markup. So that's a wonderful feature that QuickBooks Enterprise has that Pro Premier doesn't have. So again, the cost that you're seeing here, the total BOM cost, is the cost for the purposes of setting up a sales price, but it's not the average cost of the materials for the purposes of having inventory valuation. Inventory valuation is an entirely different ballgame, and we're going to be covering that in detail. I mean, we're going to go super deep into inventory valuation for components of assemblies on that part 3 or part 4 where we get to that part. So for now, we're only focused on this cost for the purposes of setting up a sales price. Now, which inventory account should I use? It shouldn't be raw materials. There should be an inventory asset account called finished goods. Okay, so we're going to be calling this one finished goods. Okay, and then we're going to create finished goods, which should be a sub account of inventory asset, and then we'll click on save and close, and then we click on OK. So for right now, let me set up a sales account. For right now, we're doing a simple inventory assembly process where we only have raw materials and finished goods. On the episode where we talk about inventory assemblies, we're going to add one more complexity to it, which is work in process, which is when you have a sub-assembly, an assembly of an assembly. We're just not going to cover that now because that's not basic inventory assembly workflow. Now, let's go ahead and now build or assemble these units. So I'm going to go into vendor. Actually, I'm going to go into manufacturing and wholesale, inventory assembly, and then click on build assemblies. Now, I want you to keep in mind that I haven't received these units. I haven't received these items. So you're going to start seeing some errors in the process here, which is fine. That's what we're trying to show here. So I'm going to make this May 24th. I'm going to pick the finished good product. And then down here where it says quantity to build, let's say I want to build 3 of them. So right here where it says quantity to build, this is what I tell it how many I want to build. And then here where it says, it's kind of grayed out on the top, it says maximum number you can build is 0. So I can't build any right now because I don't have them in stock. So when I try to save it, it's going to give me an error saying, hey, by the way, you can't build this. So you either cancel or make it pending. So if I make it pending, and again, we're going to talk about the pending workflow in detail when we talk about assemblies and manufacturing. But just for now, when you make it pending, it actually doesn't process that assembly. It just kind of makes it a non-posting transaction. I'm going to go ahead and click Save and Close. And let me receive some raw materials here so I can go ahead and do the build. So let me go ahead and select my vendor, and let's receive 1,000 RM1s, and let's receive another 1,000 RM2s. Perfect. Okay, so I'm receiving the inventory first, so I can go ahead and do my builds. I'll click Save and Close. Okay, go back into my inventory build. Again, we're going to cover that in detail in the build episode, in the assembly manufacturing episode. I'm going to select my product. Now you can see here where it says maximum number you can build from quantity on hand, that little gray text on top of quantity to build. It actually tells you how many you can mathematically build based on the inventory that you have in stock. So at that point, I can select the 3 that I want to build. My non-posting little label goes away, allowing me to now make this build complete or to post it. And then I'm going to go ahead and click on Build and Close. Okay, perfect. So now I'm going to go into my reports. I'm going to go to Inventory, and I'm going to go to Inventory Valuation Summary. Okay, and in here, let me just zoom this in a little bit. Okay, so now we're going to have our finished goods on hand. Let me push this to the 24th, which is the day I created that build. So now we have 3 in stock. Okay, it tells you here my average cost is $770 and my asset value is $2310. Now, right now, the average cost that is using is the same one that's in QuickBooks, because we haven't changed the average cost in the individual transactions. If I had purchased an item at a different historical cost, the historical cost of this product would have gone down. It would have, right? But again, we're going to talk about in detail the differences between the BOM cost, assembly cost, and the historical cost in the episode where we talk about assembly. So like, we can't really get too much into that for now. For now, it's just displaying the average cost because we haven't done a whole lot of transactions. So this will tell you exactly how much I have in stock on my raw materials, how much I have in stock in that one IP1 item that I created, and how much I have in stock in my inventory, in my assembly. Now, what's really neat about this is when I go into my balance sheet and I pull up my inventory asset, notice that I have my finished goods and raw materials as 2 different accounts. For management, it's really, really valuable to know how much inventory I have in raw materials versus finished goods. Perfect. So that should cover the basic workflow of inventory assembly items and build assemblies. Now, let me open up the PowerPoint here real quick and cover one really important slide. And most of you that are accounting professionals, you know this by heart. You took many tests in school that require you to know this, but I find that many times even accountants forget this. Okay, your ending inventory balance should always be your beginning inventory balance plus purchases minus cost of goods sold. You also need to know and understand that purchases are driven from item receipts, bills, checks, and credit card charges. Purchase orders are not going to drive purchases. Journal entries are not going to drive purchases. And cost of goods sold are driven by invoices and sales receipts. You can use inventory assembly to adjust your cost of goods sold, which we just did. We did an inventory adjustment to adjust our cost of goods sold. But you need to understand which transactions drive the purchase amount, the cost of goods sold account, and eventually the ending inventory. At any point in time that you're looking at your balance sheet and your inventory valuation are not the same, somebody mucked with it, right? Somebody messed with it and is causing your inventory to be off. Now, inventory being off is the number 1 issue that QuickBooks users have in manufacturing and wholesale. You can ask any QuickBooks consultant, you can ask any business owner of a manufacturing, a wholesale business, hey, what don't you like about your QuickBooks is that I can never trust my inventory. So inventory is off means it's always either overstated or understated. In some cases, somebody will have inventory to be off, and the value that's off, that's overstated, and the value that's off understated kind of cancel each other out. And at the end of the day, the financial statements are okay. However, there's individual issues when it comes to analyzing the specific products that you have in stock. Now, if your inventory is overstated, what are some direct causes? Well, you can be having missing invoices that are supposed to reduce that inventory. Maybe you use the wrong item on an invoice, or use a non-inventory part instead of a non-inventory part on an invoice. I would say those are the two most common direct causes for having inventory overstated, because you're basically missing the transactions that would reduce that inventory. And of course, not making timely adjustments, not adjusting your inventory, could cause your inventory to be overstated. The effect that overstated valuation has is your net income and your gross margins are overstated. What are the negative effects of having net income overstated? Well, you're going to pay more income taxes. That's probably the most obvious one. What is the negative effect of having your gross margins overstated? You could probably have overconfident salespeople giving people more discounts or getting more aggressive in pricing because their financial statements, their numbers are telling them that they have really good gross margins and they can compete by lowering the price. But what's going to end up happening is you might end up losing money on some of these deals because you are overconfident about your gross margins. So although there are some positive things for your net income to be overstated and your inventory value to be overstated, which could cause an investor or a bank to probably lend you more money or have more confidence in your business because it looks like you're richer than what you really are. However, I think the net effects, the negative effects are worse. Now, what happens if your inventory is understated? That means that QuickBooks is showing less inventory than what you really have. But what's happening with that? Well, that probably was caused by you not entering bills or item receipts for certain items. Very typical. People will just have a purchase order and forget to enter the bill, or pay the vendor and send it to some sort of cost of goods sold account and never really bring the inventory in it. Using the wrong items in a bill or using a non-inventory items in a bill, that could cause your inventory to be understated, and obviously not making inventory adjustments, which applies to both. Now, what is the effect of your net income being understated? Well, if your net income is understated, you're probably paying less taxes than you need to. A lot of people would see that as a positive, but if you get audited, you're going to get nailed on the audit. Two, your gross margins are going to feel much tighter. So if you think your gross margins are small already, you're not going to give anybody any discount. You're not going to be competitive in pricing, and you can lose some deals in the fear of losing money on your sales because your gross margins are understated. So you can have the negative effect on both. Also, if you're looking to get financing or bring investors in or get a loan or whatever, and they're looking at your inventory value and they're looking at your net profit, if you're understating your inventory and your net income, that can have some negative effects for that. Now, how to quickly know that your inventory is off? Like, how do you quickly know that? Well, the easiest way to know is you look at your inventory valuation summary, you look at your balance sheet. If they don't agree, you know for a fact something's wrong, period. And the other thing is you want to look at the inventory asset value in your valuation summary, and you want to check for gut feeling. Does this feel right, right? Like, I'm looking at the valuation report and I'm thinking, I can't have this much value in inventory. That's impossible. So if it doesn't feel right, it's probably not right. Okay, so those are the two things that allow you to quickly know that inventory is off. Now, what are the specific actions that the user took that caused this problem? Well, number one, probably the most typical, is somebody will do a journal entry affecting your inventory asset. Okay, let's do an example of that just so we can illustrate exactly what problems that would cause. So let me go ahead and pull up my inventory valuation summary. I'm going to pick all dates, and then I'm going to run my balance sheet. and I'll also pick all dates. I'm going to go ahead and go to Window, Tile Vertically. Then I'm going to collapse this left navigation bar, tile vertically again so we can see it. So my asset value is 107,800 according to my inventory valuation summary. This is where you run a quick gut check, right? Does that number feel right? Okay. And then 2, you want to make sure that the inventory asset value in the balance sheet matches. What a lot of people do, and these are, and I have to say it this way because it's the only way to say it, the dumb accountants. The dumb accountants do this all the time. The dummy accountants that are only looking in like sort of this myopic view to say, look, I just got to get QuickBooks right so I can get the tax return done. And my customer's telling me that inventory is 50,000. So I need to adjust inventory value and make it 50,000, period. Move on. And I understand why you would do that. As a matter of fact, I've been that dumb accountant many times, mostly because my customer is not paying me to audit their inventory for that particular use case. But causing this is going to have some major issues in the long run of having of your inventory value. So if I go to my inventory asset and I reduce my inventory by 57,800 because I want to just make sure that my balance sheet shows 50,000 in my inventory asset, right? And I run that against my cost of goods sold account, whichever one happens to be, and I click on save. Okay, I could probably comply with having my clean balance sheet that shows my clean inventory asset of that random number the client gave me that they pulled out of a hat of 50,000. So great. So you made your financial statements work. But the problem is that now at any point in time, you're going to pull up your balance sheet and your inventory valuation report, and you're going to see that both these numbers are off. When these numbers are off, automatically your inventory is off. So you can do your gut check on inventory valuation report, and if your gut check tells you that's okay, then your duty is to reverse the actions taken by the previous accountant and make your inventory asset always match your inventory valuation report. If the end user, the business owner, is looking at this and says, no, it's 50,000 for sure, I know for a fact it's 50,000, then that person needs to do the exercise of figuring out what combination of adjustments I need to do inside of my valuation report to then make it work for 50,000. So you have to make the actual adjustments to the actual units that will get you closer to that 50,000, so you cannot have, so you can stop having that discrepancy. So I would say that's the number one problem. Would love to know in your comments below if you have experience with this in the chat. What is the number one issue that you see with inventory being off? I think that making journal entries to inventory asset is the number one problem. Number two, most common, is when you make an inventory adjustment. I mentioned this earlier. You make an inventory adjustment, and instead of using a cost of goods sold account to make the adjustment, they use the same inventory asset account to make the adjustment. And basically, you're going to be it has no effect. So if you do an inventory adjustment, right, and I'm going to show you that too. If you do an inventory adjustment and you use the same inventory asset account, you're going to have all sorts of issues. So we're going to have an episode where we talk about inventory troubleshooting, where we're going to cover this specific issue and how to fix it. Okay. Also, we can have issue with inactivated inventory items. So sometimes people will inactivate an inventory item and it doesn't show up in the valuation report. I'll show you this one. That's a really good example to use just because it's a pretty common use case. So let's say, for example, I'm looking at my inventory valuation report. It's 107,800. But if someone goes into the item list and decides to willy-nilly say, you know what, I don't have any more RM1s. Let me just get rid of it by right-clicking and deleting. And then QuickBooks says, look, you can't delete it because it's got a quantity, but you can make it inactive anyway. And then you completely ignore that it's saying that your valuation is going to be off. So you click on make inactive, and then you make it inactive. Okay. Make it inactive completely. When I go back into my valuation report, now my asset value is off. So you looked for it, right? You did this problem. You created this problem by making the inventory, specific inventory, inactive. Now they've in QuickBooks QuickBooks Desktop, both Pro Premier and Enterprise 2019, they fixed this issue by having a little checkbox here that says show inactive inventory items. So that inactive issue is no longer a major issue. As long as you check that box, then you can reverse the effects of making an inventory item inactive. However, in my opinion, you should always be searching your item list. You go into your item list and go to where it says include inactive and sort it by the inactive ones. And then you want to go through the list of all the inactive ones and spot any that effectively have a quantity. Because if an item has been inactive, the end user probably doesn't have any more of the item in stock, and they're trying to remove it from the visibility because they don't want to see it anymore. It bothers them. However, if it's showing a quantity in stock, it's probably showing a value in stock. So it's really, really important that you basically go back and adjust that to 0 if you want to keep that inactive. So it's a bit of a troubleshooting that we have to do. We'll talk about in the troubleshooting episode. We'll talk about that. So let's talk about the next couple items here, which is using the wrong units of measure on transactions. Very typical when someone has multiple units of measure where they buy by the unit, by the dozen, by the 50 unit box or whatever, right? Or by the pound, by the gram, all those things. What ends up happening is they don't pay close attention to first of all, to the unit of measure setup, make sure the numbers are accurate. And then second, when they go purchase it, they don't pay attention to that unit of measure. And then they overbuy units based on the unit of measure, or they underbuy and they use the wrong unit of measure. That's actually a very typical thing. In manufacturing, unit of measure is probably one of the most important things that people need to learn first before even touching QuickBooks. Then obviously we talked about this earlier, using the wrong items in a transaction because they're similarly named. That's also a very typical cause of an inventory valuation issue. Negative quantity on value items. So if your items are negative in quantity, they're also going to cause QuickBooks to do all sorts of weird calculations into cost of goods sold and inventory asset. So you want to make sure that you never have any negative inventory quantities. And then there's a really weird, strange one, which is QuickBooks doesn't have a control mechanism for leaving inventory items in stock. Sorry, having inventory items that are not in stock, but still retain a balance in the valuation report. It's a really weird, strange thing. And let me show you that example, and then we'll probably discuss more in the troubleshooting session of that. But it's just really, really interesting that QuickBooks can do this. I'm going to do an inventory valuation adjustment, and I'm going to adjust this one called finished goods. So I'm going to go into finished goods. Okay. I'm going to do a quantity and value adjustment. I'm going to do a quantity of 0, but then under new value, I'm going to put 5,000. Okay. Don't ask how this works, but QuickBooks can actually do this. You can actually have 0 of a unit, but still have value of the unit in your valuation report. And this is one of the craziest things in the world of QuickBooks. Now, sometimes, anytime anybody does a value adjustment, they can potentially cause this problem. And I've never seen somebody actually do this on purpose, but I have seen the net result where you have 0 quantity on hand and a value adjustment. So typically what I do is I'll export this to Excel, and then I'll run a couple of formulas to see, hey, is there any column that says 0 on hand, but still says some sort of value under asset value? And I filter those and then go back into QuickBooks, and I literally just adjust the value down back to 0. This is one of the most crazy things that, unless you're kind of dabbling in, I mean, you're doing, beyond dabbling, you're doing inventory troubleshooting and consulting with these type of companies, you really won't even notice that. Okay, so let's talk about probably the most important part of this, which is average costing versus FIFO. So average costing versus FIFO. Let's go ahead and switch over back to QuickBooks. Actually, let me take a quick 30-second break so I can drink a little bit of water. All right, let me go over the questions real quick. Okay. Is there a way to use a zero sales for consumption to debit an expense account, but not a cost of goods sold account? So Kira, that would only work if your inventory item is pointing to the expense account. Okay, next question. Will the individual series be recorded and available as trainings are completed? Yes, so every one of these episodes is 8 episodes in total. This is episode 1. It's going to be recorded, and episode 1 will be posted into YouTube because it's going to be a promo for the rest of the series. And in the portal, when you pay for the series, you access the portal, all the recordings will be there, and you will have access to those recordings forever, right? So yeah, everybody will record it and it will be posted there. So if you don't show up to the recording live, you'll be there. So what's the schedule for the upcoming 8 series? It's going to be like this. It's going to be 1 p.m. the third Thursday of every month, 1 p.m. Eastern for the next 8 months. Simple. Okay. Practically one is not going to know that there's any pending assemblies for an item received. How do you know when to process a pending build? Okay, so Jolene, good question. So if you have pending builds and all of a sudden you can convert that pending build, is there some sort of report or notification that QuickBooks will tell you? So there is, Jolene, kind of, and you're right. It's going to be very difficult to get that result. So I'm gonna look at the inventory stock status report for a second, and then I'm gonna go into one of these builds, and I'm gonna make this build. Pending, just to show you. I might not have done a good job at reading her question and making this make sense to everybody, but I'm going to illustrate it. So if I have a pending build, okay, in which I don't know if I'm ready to make the build pending, in the inventory stock status report, there's actually a column called for assemblies. And the for assemblies, what that tells me or lets me know is that an item, it's in a pending build, so it could be received. And you can also have it could be, so the specific item is set up in an assembly, and then you can see every item that it's in a pending assembly. That's basically for assembly means. These are all the items are in a pending assembly. So you can tell which items are in a pending assembly. So if you see any quantity on hand that are positive and they're sitting there in a pending assembly, you know that item is ready to be assembled. What you don't know is which assembly is ready to be assembled without going to it one by one. So if I go into my pending builds, and these are all my pending builds here, I literally have to click on each one and click on build and close, or click on remove pending status and see if it lets me. So you can only know when a build is ready to be converted from pending to regular by opening it and looking at it. That's it. So there's no other. So you're right, Jolene. There's no notification system that would tell me when a pending build is ready to be built. That's a big drawback that QuickBooks has. Nick is saying, can I add labor and overhead to a bill of materials? The answer is yes. We're not covering that today. We'll cover that in episode 4, or whichever episode we're going to be covering bill of materials in detail. But yes, that could be done. Okay. All right. So let's talk about average cost. So this is going to be fun, a lot of fun. So let's go ahead and pull up a profit and loss report. And I'm going to make this, let's say, the 1st through the 5th. Okay. And I'm going to make this by day. Okay. Perfect. So this is going to be our baseline. We're going to use this report to kind of track everything that's going on. I'm going to create a new item. And let me make this, I'm going to call this has avocado. Okay. So we're going to, an item that has a lot of variability, vegetables, commodities, they have a lot of variability in cost. And let's say that generally speaking, this product will cost about 50 cents. What I put here doesn't really matter, but generally speaking, it costs about 50 cents. So I'm going to go ahead and click on OK. I'll pick an income account here. Okay. And then I'm also going to run a balance sheet for those same 5 days so we can track it. So let's do 05, 0105, 0501 2020 to 0505 2020, and make this balance sheet by day. Okay, so I'm just going to have these two financial reports up so we can be monitoring exactly what's going on with all the transactions that we are creating. Okay, that should be good enough. Okay, so let's start by purchasing some Hass avocados on the 1st. So I'm going to go into vendor, enter bill. Let's go to our sample vendor. Let's do Hass avocados. And on the 1st of the month, I'm going to order 1,000 at 50 cents each. I'll click on save. Okay. And in my balance sheet, there's $500 of total inventory asset. Okay. So I'm going to go ahead and sell one. I'm going to sell one. So I'm going to go to customer, create invoice. I'm going to sell one unit on the 1st. Okay. I'm going to sell it for $1. Actually, I'm going to sell it for $0 just so we can make it much easier in the report itself. Okay. So what is my cost of my unit? It's 50 cents, right? That's clearly, it's simple. We know we received it at 50. My cost is 50. Now, what happens on day 2 when I receive it at a different price? So I'm going to go into vendors. I'm going to go to enter bill. And then on day 2, I'm not going to receive the same Hass avocado. I'll receive 1,000 units, but now at $1. So now I'm receiving 1,000 units at double the cost. So 1,000 units at double the cost. I'm going to go ahead and click on save and close. Okay, now I'm going to sell one unit the next day, right? When now I have basically an average cost issue. So let me go into customers, create invoice, select my customer, sell one unit of Hass avocado on the 2nd. And let's do it 0 sales price. So one unit, 0 sales price, save and close. So what's my average cost now? Exactly as expected is 75 cents. Okay. So that's easy, super clear, 100% clear, right? That should be easy, very, very clear. Now, what happens if I sell an additional unit of Hass avocado? What would be the cost? Okay. So I'm going to ask you that question, put it on the chat box. If I sell one more additional unit of Hass avocado, what do you expect the cost to be? Okay, so everybody's saying 0.75 cents. So the answer is, it depends on the day that I sell it. It depends on the day that I sell it. So the way QuickBooks works with average cost, it is date centric. It is date centric. So if I sell this unit, I'm going to show you right now. If I sell the Hass avocado on the 2nd, in which from that point forward, the average cost is 75 cents. I'm going to put here 1. I'm going to click on save. And then I'll do a Control Y. It is 75 cents because I sold it on the 2nd. I want to make sure that's clear. It's when I sold it. If I pull back this invoice to the 1st and click on save, my cost is now 50 cents. So QuickBooks is proactively and always recalculating cost of goods sold based on the date of the transactions. Okay, I'm going to push this back to the 2nd. Click on save again. Control Y. I'm expecting to see 75 cents. Now, on this same invoice, which I'm not going to modify the invoice, I'm now going to modify the bill in which I received the units at $1. So I'm going to go into my bills. Okay, these are the units I received at $1. I'm going to change this now to the 3rd. So now I'm basically going to receive this bill 1 day in the future before that invoice. And note, I am not modifying the invoice. I'm only modifying the bill. I'm going to click on save. Then I'm going to go back and do a Control Y on my invoice. Control Y is down to 50 cents. Why is that? Because QuickBooks will always recalculate cost of goods sold and average cost based on the date of the transactions. And the average cost ends and the average cost ends when that lot ends. So let me show you something that's just really curious here. So I'm going to go into item list and I'm going to modify the Hass avocado. I'm going to make it 37 cents, the index cost. I'm going to make that 37 cents. I'm going to click on OK. And now I'm going to create an invoice. I'm going to create an invoice prior to whenever I received that inventory. So let me go to customers, go to create invoice. I'm going to pick a different customer and I'm going to push this back to April. So before April, I didn't have any inventory in stock. I'm going to have 1 unit of Hass and I'm going to click on save. And then, so what is my cost? Technically, it should be 0. But then what QuickBooks will do is QuickBooks will actually use the cost in your item list as the cost. So this cost will be used in your item list as the cost when the absence of an average cost, when there's an absence of average cost. So at any point in time that I sell units that I don't have in stock, QuickBooks is going to resort back to its original cost in the edit item window in order to post into cost of goods sold. But then something really interesting happens. The day I receive the inventory, 2 things happen. 1, QuickBooks goes back and posts a correction to your cost of goods sold of the previously wrongly reported inventory because we did an invoice in the absence of average cost. QuickBooks is going to true up your average cost always based on that bill. So anytime you see QuickBooks post a dollar value into cost of goods sold with bill, this is QuickBooks correcting a negative inventory issue. And this is the only way to now have a true average cost set up. So it's a really interesting concept. And I'm going to show you one more thing. Okay? I'm going to show you one more thing, which I'm going to go ahead and create an invoice on, say, on the 3rd. So I'm going to go to customers, create invoice, sample customer. I'm going to do this on the 3rd. I'm going to sell every single item of Hass avocado I have in stock, which is $19.96. $19.96 at 0. I'm not really concerned about the sales price. Okay, I'm going to pull up my profit and loss again from the 1st to the 3rd, I believe. Okay, so there's all my costs, and now I have officially exhausted all of my inventory, and my average cost was calculated. Now let me just make sure I don't have any more of those Hass avocados in stock. I don't. Perfect. Okay, so as of the 3rd, I don't have any more Hass avocados in stock, but Hass avocado now has officially, now this has officially an average cost. The average cost for this is 0.7505. So that's the new average cost that it has based on historical transactions. I have no more in stock, and my index cost is 37 cents. So the big question is, what happens if I sell a negative quantity? So now I'm going to sell a negative quantity. I no longer have any in stock, and I'm going to go up to, like, let's say the 5th, and I'm going to sell, let's say, 100 units of Hass. Okay, I'm going to click on save. What cost is QuickBooks going to use? So QuickBooks would actually use, these are the two options you have. It will use logically it should use the index cost in the item window, but some people would argue, look, there's already historical cost, even though there's none in stock, it should use that instead. So what QuickBooks will do is, after there's historical cost, it will now use its historical cost as the new index cost. Where before this historical cost, it would use what's in the item list. So, so if you thought QuickBooks behaved crazy before you actually did this sort of analysis, now you know how QuickBooks has really, really strange, crazy behavior. But understand that this is all within the logic of trying to make average cost work. Okay, so that's average cost. So I hope that's clear for everyone. Let me go ahead and enable FIFO, first in, first out. So I'm going to go into inventory and go to advanced inventory settings. And I'm going to enable FIFO. And let me go back and do 1-1. Let's do 06/01/2020. I'm doing that on purpose so when I enable FIFO, I have the option to retain average cost up to a certain date and then only use FIFO from a specific date. So I'm going to go ahead and click on OK and OK, and that's going to turn on my FIFO. So if I go back into my item list and I go back into my Hass avocado, it has its calculated average still the way it's supposed to be. Okay, let me create a new product. Let's call this cherry tomatoes. And we're gonna make these $1.69. That's the index cost, correct? Click OK. Let's pick our sales account. Okay, so I'm gonna go ahead and create 3 bills. I'm gonna go to enter bill, and I'm going to create 3 bills. So on June 1st, I'm going to receive cherry tomatoes, 100 at $1.69. Click on save. Then I'm going to create a duplicate of this bill on the 2nd, and I'm going to receive 100 at $2.50. Click on save. And then I'll duplicate this bill one more time on the 3rd, and I'll receive these at $1.35. So we clearly have a variable cost across these cherry tomatoes, and we received on 3 different instances, 3 different lots per se. So in QuickBooks, this is called a FIFO lot. It's kind of a complicated concept. It's called a FIFO lot. Under the inventory report, we have something called FIFO cost lot history by item. And when I click on this, we can actually look at per item, we can see our entire lot history. So we can actually see that on the 1st, we have 100 units at $1.69. We have on the 2nd, 100 units at $2.50. And on the 3rd, 100 units at $1.35. If I go into my item list and I go into my cherry tomatoes, there is a calculated average. So QuickBooks will still keep calculated averages for the purposes of, let's call it safekeeping, but your financial statements are going to be displayed at FIFO. So let's keep this report open, because this is probably one of the best this is probably one of my favorite reports when it comes to illustrating how FIFO works. So we'll keep this report open here, and I'm going to go ahead and make a couple of sales. So I'm going to go into customers, create invoice, and then I'm going to create one invoice that sells everything from the first lot. So let's make this invoice, let's make it July, easier. Okay, July 1st. I'm going to select my cherry tomatoes, and then how many are in the first lot? 100. So I'm going to sell 75 from the first lot. Click on save. So let's select the customer so I can save it. And let's do the trusty control Y so we can see what the cost is. And the cost on this is How many did I sell? 75. Okay. So the cost on this is 126.75. I'm going to enable a column called sales price. Oh, that's already there. And we have quantity. And then we have amount. Okay. So just wanted to have the amount there. Unfortunately, I can't tell the individual unit cost for this. I can only see the overall cost for this. I would only be able to see the individual cost if I were to just do one. So if I were to just process one, I could see it. One way of doing that is to do this, to do 74. I know it's kind of weird, but it's one way to do it. So we can do 74 and then a second one with a 1. And that would allow me to then see what the unit cost for this was. Okay, so it's $1.69. So very clearly, $1.69 is my unit cost on this first lot of the first 75. If I go into this report, the FIFO cost lot history, you can see exactly where it actually keeps track of what's happening here. It keeps track of what transaction and what customer consumed that lot. So you can see here that on the first 100, 74 are for this transaction, 1 is for the same transaction, and then you got 25 left. Now I'm going to go ahead and create another invoice. I'm going to go create new, and I'm going to call this one lot 2 customer, just to make it a little bit easier to read. And let's say I'm going to sell this customer cherry tomatoes. I'm going to sell them, let's say 60. Okay, what this is going to do is it's going to take 25 from the first lot and then the other 35 from the other lot. So I'm going to click on save. So now I go back into my report and then we can see that lot 2 customer consumed 25 from the first lot at $1.69 and then consumed 35 from the other lot at $2.50. If I were to do Control Y inside the invoice and click on refresh, you will just get the overall cost of goods sold. It won't give you the details the way this does. So if you actually wanted to know, transaction by transaction, item by item, what FIFO lot the cost is coming from, it would be through here. Now, where this becomes interesting is, let me go into, let's go back here and to simplify this. Okay, 75. I want to make the other one 75 too. Okay, I'm going to make the second one 75 too, just so we have apples to apples comparison. And then I'm going to make this July 2nd. And I'm going to run a P&L for July 1st and July 2nd so we can see what posts into cost of goods sold for each invoice. So July 1st, July 2nd. Let's do it by day. Okay. There you go. Very clear. So on the first sale of 75 units, I have a cost of $126.75. On the second sale of also 75 units of the same invoice, I have a different cost structure altogether. And now I'm going to create one more invoice. Let's do, how many do I have left from the second lot? I got 50 left. So perfect. So let me do another invoice. And let's make this on the third. And we'll take the same product and let's do another 75. Click on save. Let's pick a customer. Okay, so now I'm going to look at the P&L for the 3 days. Now we can see that my cost of goods sold now sort of averages down. Okay, because now it's consuming some from that third FIFO cost layer. So I know it's a handful to deal with it, but it's just extremely important to know how QuickBooks evaluates inventory, how it comes about coming up with that number in the inventory valuation report. When you have FIFO turned on and you go to inventory valuation summary, QuickBooks will still do calculated averages for you. Okay, so you will still have access to seeing your calculated average. You still can do that. You can still see your calculated average. However, the asset value is going to be based on everything you have in stock And when it comes to doing a valuation report, QuickBooks could technically go back to averages for asset value because it's going to be using calculated averages of what you have left in stock. So this is not the calculated average of the cost. So let's look at the item cost real quick here. Let's go to cherry tomatoes. Okay. So when you're dealing with average cost, the calculated average is the calculated average of the history. With FIFO, the calculated average is the calculated average of what you have in stock. So that's a really important, clearly distinction. So calculated average under average cost is the average calculated value, and calculated average under FIFO is what you have in stock. So the real calculated average for this is not $1.35. I'll prove it to you. I'm going to go into sales by item summary, and we'll do all dates here. Okay. And notice that my cherry tomatoes have an average cost of $2. So the historic performance in sales have posted into my cost of goods sold an average cost of $2.01. However, However, in my balance sheet, what I have left in stock that has not sold, the calculated average is $1.35. So these are two different distinctions between the calculated averages. Perfect. Okay, so we're done with our 2 hours. I was hoping we were able to get to landed cost and find and select and the ultimate item fetching shortcut and item receipts versus enhanced inventory receiving. So we're gonna cover these on the next episodes. Since I do have like 3 minutes left, I do want to cover one thing. This would be mind-blowing to some people. Like if you've never seen this before, it would be one of those little mind-blowing little tricks. So I'm going to show you something real quick. So let's say, for example, I have my invoice open, and I'll cover this in another episode in the future as well, because I'm doing it fairly quick. And I'm trying to pick an item from a very long item list. And let's say I don't have Pro or Premier. I don't have Enterprise, so I have Pro or Premier that would not give me access to the special Find and Select Items feature. So one of the ultimate tricks is while you're sitting on an invoice or any transaction that needs to fetch an item, you do Control L on your keyboard. So you do Control L while your item code field is selected. That will open up your item list. You can do your search. Let's say you have a really long list. You can do your search, just type has and click on search. Narrow down the items. Once you find out the item that you want, select it and hit Control U. What QuickBooks will do is it will insert the item from your item list into the last transaction you have open. So again, let me close this. We do Control L. I'm going to do a search within my item list. Let's just search for RM. Okay, there it is. Even if they're inactive, it works too. Search for RM and then hit Control U, and it'll insert it into the transaction that you're in. So we'll cover that again one more time, just in case I was too fast. That's a really, really cool trick. I think if you don't know that trick, you're missing out quite a bit. I'm gonna shift some of the topics and fit them into the other episodes. So let's conclude this, right? My goal was to deliver in this one episode so much value that even the most experienced people using QuickBooks Enterprise, QuickBooks Premier for manufacturer and wholesaler get something out of it. You are investing 2 hours of your time, and you will continue to invest 2 hours worth of your time for 7 more episodes. If you're serious about learning QuickBooks manufacturer and wholesalers, I can say hands down, there's nobody else to learn this from. I have researched the topic. There's nothing on the internet that deep dives into these topics the way I do. This is a niche product, right? I know a lot of people are shifting to QuickBooks Online. I know not that many people are loving QuickBooks Desktop. I know most accountants are being told that the only way to be efficient and the only way to serve your clients and the only way blah, blah, blah is to go to QuickBooks Online. But there's a lot of small mom and pop manufacturers with less than $1 million in inventory, less than 50 employees, less than $20 million in sales. These guys are perfect for QuickBooks enterprise manufacturing and wholesale. The software is a fraction of what the competitors cost in this space. If you look at manufacturing apps in this space, they're $10,000 to $50,000 and above. So if you can somehow be able to squeeze value out of QuickBooks Enterprise, keep people on a platform they understand, save people that from frustration to going to some random platform and paying tens of thousands of dollars for consulting. If you can help somebody get QuickBooks Enterprise working, their manufacturing and wholesale business like a well-oiled machine, and you can get people to have the inventory to be accurate, you can really increase the performance and the output from that company. And right now, and this is something I said before, I'm very passionate for manufacturing because of one specific reason. When I lived in South America, when I lived in Venezuela, I remember we used to get toys or widgets, whatever we used to get as a kid, right? I always remember looking at the bottom and looking at the sticker. That sticker would either say made in USA or made in China. I remember clearly as a kid, and in Spanish, we used to say made in China, made in USA. And even as a kid, we knew that if the sticker said made in USA, it was quality. If it said made in China, it sucked. And unfortunately, way too many things are made in China. And like, to me, spiritually, beyond the money I make from being a consultant in this space, spiritually, seeing Americans create products and Americans manufacture means a great deal to me. So I like working with these type of clients because I know that if I help them succeed, it will help our economy and it will bring manufacturing and it will bring production back to America. I know that sometimes it's a dream. I know it's impossible to compete with Chinese manufacturers or whatever. And I know that the environment makes it difficult for many American manufacturers to make a comeback. And beyond the political aspects of bringing manufacturing back to the US, like, to me, to see creation, to see people create something from something else is very exciting. And if you have never walked a warehouse from a manufacturing client, if you've had the opportunity to walk a warehouse and kind of spend half a day in the shoes of a person that creates product, you haven't experienced what I have experienced. So I'm truly passionate about it. And I wish a lot more consultants were deep into manufacturing so they can support clients. I personally cannot support the amount of clients that come my way. I get so many leads, so much people asking for support. There are so many messy QuickBooks files when it comes to inventory. And I try to do as much as I can, right? So I try to do as much as I can. I try to take the clients that I can. I charge top dollar. I think that if you get into this space, you can do that as well. Anyway, I hope to see you on the next one. And thank you very much for joining me today. Have a good day.